Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. Happy New Year to all of you. In today's video we are looking at UPS. I know I've got so many questions over the last few weeks regarding UPS and where is the company's heading, because it has not been a great investment for me anyway this year. So what my plans are, what I'm gonna do, and what the problems are moving forward. We're going to talk about the financials, we're going to talk about the valuations, and I'll tell you exactly what I will be doing at the end of the video, inshallah. Right, so UPS, I'm sure you know the company and what they do. This is one of the best companies out there when it comes with regards to parcel deliveries. They work a lot with Amazon and so on, but recently things have not been great, okay, and there are a few reasons why I say that. So I'm going to highlight some of those things, and then we will get to the financials and understand how the business is actually doing. But let's find out first what the problems are. So one of the major things the company is facing right now is increased labor costs. What do I mean by that? In 2023, UPS reached a labor agreement with International Brotherhood of Teamsters, basically, and that resulted in higher wages and benefits for employees. So the company now has to pay more for existing members of their workforce. So that's the first one, and that can be a lot. And if you can think about, like, every single person that works for the company is now getting more, okay, basically in terms of salary, than they were getting before. So that money has to come from somewhere. So the company is spending a lot more money basically in terms of in terms of labor cost. The second one is competitive pressure. UPS faces basically intensified competition from traditional rivals like FedEx and so on. And there are some emerging ones like DoorDashes and Instacart and so on, because the stuff that they used to deliver, the small stuff, is now delivered by these companies, which is not great for the company. So there are a bit more competition on the streets, okay? The other thing is the shifts in consumer behavior. There are noticeable trends of consumer opting for more economic shipping options, because UPS can be high-end priced sort of, and they basically, some of these people are actually opting for a cheaper, which is absolutely understandable, especially in a situation where people have not had any increases in their salaries, and maybe in a recession situation that can easily happen. So the company has gone through all of these things, and it is going through all of these things. So some of the things that they came out and basically said, you know what, this is what we're going to do is, for example, operational adjustment. So one of the things they're doing right now in response to the financial pressures that they're feeling right now, they've announced that their plans to cut 12,000 jobs and exploring the sale of another company that they used to own. So that is a good thing. Okay, so the fact that unfortunately people will lose their jobs, but that means now they will be paying less in terms of salaries, and potentially take that money that they were given to those 12,000 people and distribute it among the other people. Okay, so that's one thing. So we will see what happens in the long run, but generally those are the things that the company is going through. I'll show you exactly how many shares I own of this company, what I plan to do inshallah moving forward. But let's have a look at the financials. And right now we're not hiding anything. I'm going to show you exactly what I think about the business. Okay, so a year to date is basically 20% down. It's not the only company that's down 20% right now. So 20 plus percent. PE right now we're looking at about 16. Okay, now with Wall Street, let's have a quick look, and I'll show you exactly. In fact, we'll come back to Wall Street, but let's go to financials first, because this is the most important thing, right? So right now the company total revenue is about $91 billion. They spend about $70 billion of that. This is a very capital intense business. Okay, so they're spending about $70 billion of the 90, and their gross profit here we're looking at about $20 billion, which is not bad at all. $20 billion is a lot of money. Then they have basically a lot of things, depreciation, amortization. They've got other expenses. They've got, do they even have any research and development? Because a lot of these companies do not. Anyway, operating income, we're looking at about $10 billion. Let's say trailing 12 months, about $8.4 billion. Now, after they've done all of these things, they pay some taxes and exchange rates and all of these things. We have a net income of $5.6 billion, which is very good. very, very good. And if you look at the basic EPS, it has been growing from $3, 5, then it dropped to 3, then to 5. Is a very cyclical business because it depends on how the economy is doing. If people are buying, so during COVID time, this company has done absolutely amazing. So 2020 and 2021, you would expect this company, in fact, not 2020, 2021 and 2022, because the effect of it was not felt straight away, right? 2021 is when they felt that jump from $1.55 to 14, almost to $15 per share, because a lot of it, because we were stuck at home and everyone was ordering, right? So that's the basic EPS. Now, the other things I want to share with you guys is to check now the debt levels of this company. So we want to see if they have a current assets that are higher than the current liability. So we go to the balance sheet, we'll scroll down here to where it says total current assets. So we've got $17.2 billion. That is stuff that they can liquidate very quickly if they need to within the next 12 months to pay off any debt that company has, right? So right now we're looking at about 17.2. If you scroll down, total assets, we're looking at about $68 billion, which is good. Let's now check that against the current liabilities. Current liabilities is $15 billion. We've seen this is $17 billion. So the total current assets cover the total current liabilities, which is good. That's the most important thing. Long term, we're looking at about $68 billion of total assets against the total liabilities of 51, and that also covers, which is very, very good. The other thing we also need to keep an eye on is the total debt here. So the total debt has increased from $10 billion in 2014 as the company's revenue and everything, operations, everything grew. Of course, it did the same thing as well. But it has declined from 2019 and 2020. We were looking at about $27 billion. Right now, it's about $26 billion, which is not bad at all when you think about it. So we've got company that's healthy. Okay, they can cover that. Now, a couple of more things. I want to see the free cash flow of this business to, of course, see where the company, how much money is going into the free cash flow side of things. Right, so here we've got it. We've got the $5 billion to 4 to 3. It dropped massively in 2017. Then it bounced back up again, 3.5, and then 1.3 is very choppy. It's got up and down. $2 billion, 7.8 because they made a lot of money that year. 2022 was also a good year, 8.2. Now it dropped to 3. Right now we're looking at back again for the trailing 12 months. So that's not bad. $4 billion of basically free cash flow. Right now, free cash flow per share is also looks like it's growing, heading in the right direction. It was a slight dip here and there, but majority of it is fine. So balance sheet looks fine. So income statement, the balance sheet, the cash flow, all of them look decent. Let's now have a look at the earnings expectation for moving forward. So that's the other thing that we need to look at. And as you can see, 2025, they're expecting the earnings to grow about 17%. And this is, for me, the most important thing. There's about 31 analysts looking at this, and they're saying it will grow about basically year-over-year growth. But remember that we had a massive decline, so we were starting in a really bad position in the first place. But 13% again, and then 11%, and so on. Then when it comes to revenue side of it, this is one of the companies that you expect at least a 5%, 5 to 10% every single year, because they are a huge company. They're making that much, so it's not easy to move the needle if you think about it. Okay, but if you look at this, we got about 4%, again another about 5%, and another 5%, another 6%. So not bad at all. There's nothing huge to worry about. Now let's have a look at the overall information about the company, and then I'll show you the valuation side of it. It has a wide economic moat, 107 billion market cap right now. If we look at the current PE we've seen is about 19, the forward PE is 16, and the 5-year average is 16, which tells us it's trading around where it has been over the last, expected to trade around where it was for the last 5 years. So 19 is the sector medium. Now this is where the company shines, and maybe not so great either as well. Okay, it's a bit of a weird one. The 5% dividend yield right now. Okay, the payout ratio is 87%. We've seen already they've got $4 billion, over $4 billion of free cash flow right now, but here we've got 87%. annual payout is $6.52. So of course, let's not actually not go over this quickly. This is very, very high. But if the revenue start growing again, things slightly pick up, this will start reducing. And I think the company will have to make sure, because remember what this means is they're spending almost 90% of their net income to give us this dividend. And this is why I always say sometimes when companies get to that sort of a level, you're better off cutting it and then basically just to pay what you can sort of thing, right? We got $6.52, but I don't think we're at that stage yet. Okay, so we'll see what happens. The 5-year growth rate, we're looking at 12%, which is really good. 14 years of increase in that dividend. Safety is 69%, so it's still safe. And they do have free cash flow. The free cash flow compound annual growth rate is looking good. Free cash flow margin looks decent. And profit margin, return on equity, return on invested capital, it's okay-ish. It's not great at all. Okay, return on invested capital is really good. Return on equity is good, but these two, profit margins and operating margins, are not good right now because the margins have been squeezed a little bit by what is happening with the labor situations and so on. Now, the net income for the last 5 years, we're looking at about 8%. Total return the last 10 years is 4%. Okay, that includes dividends as well as, of course, price appreciation. So that's not great either. Now, revenue side of things, we're looking at about 5%. Growth in the last 5 years. EPS is a decline, but we've seen it. It was expected to grow whatever 14%, whatever it was for the next year, 16%. Current ratio, we've already seen it. Current liabilities is covered by the current assets. Apologies if my voice is all over the place because I've had this cold and it's not leaving me alone. It's just been really horrible, and I'm trying to do as many videos as I possibly can for the community before I go back to work, InshaAllah. But I'm going to continue doing this, InshaAllah. If you are enjoying, by the way, please just stop right here. Genuinely takes a lot of time and effort to put these videos together. I appreciate genuinely every single one of you guys out there that help the channel every single day, pressing that like button, watching the videos, commenting. And it means genuinely the world to me. And the reason I said that is because we're reaching out more brothers and sisters. This actually channel has been on for 4 years and we've only got 8,000 subscribers. That's 8,000 more than I've actually expected. I thought I'll have 5 subscribers and so on. And genuinely, like, it means the world to me to be able to reach out this many people. And of course, InshaAllah, one day we will be able to look back and say, you know what, we've actually helped other brothers and sisters to get into this stock market thing. Because the amount of people that I'm going to talk about this another day, but the amount of people that I talk to that genuinely think the stock market is no-go place, like no, you should not be putting any money in the stock market, and they don't want to even entertain the idea. Then when you start talking to them, like, really? I didn't know you can buy those. I didn't know those existed. I didn't know you can do these things. And this is what we're trying to do. So you liking the video, subscribing and sharing with your family and friends, we're spreading the word and helping the ummah. And all we want to do is get this out of this rat race and take care of our futures, so you are able to travel, to do the things that you want to do umrah, do hajj, and spend time with your families, loved ones, and the things that are are important to us. Not this rat race. You go to work and you come back exhausted and you do the same thing over and over again until you're 67 and your bones can't even work anymore. Come on, man. Subhanallah. Let's do this, inshallah. If you can help, that would be absolutely amazing. And of course, if you can help us on the Discord and join us in the Discord, join us in the Patreon account, that would be absolutely wonderful as well. Right, moving on. Next year, we've already seen they're expecting the earnings to grow up, revenues to grow about 4%, earnings to grow about 16-something%, almost 17%. The current price is $126 per share. According to Morningstar, it's undervalued by 16%. According to Simply Wall Street, it's actually 25%. According to TipRank, for the next 12 months, they think it's about 14% discounted right now. And almost the same goes for Seeking Alpha. So everyone kind of agrees the company is trading under their intrinsic value. And I'll show you exactly when we combine all of that. As you can see here, from Sharia compliance side of things, nothing to worry about. 23 is slightly high. However, it's not the high. So of course, we're looking for 33% or 30%, whichever you use. Okay, shares outstanding is declining, so the company is actually buying back their own shares, which is quite nice. You got the 5% dividend, you get buybacks from the company, and inshallah we're expecting about 16% earnings growth, 17%. Remember, the reason this is important to me is this because if this is growing, then that means the revenue of the company is making money. Okay, we might be spending a little bit more money on the labor side of things, but that will adjust over a period of time. That's not just going to happen overnight. That was going to stay. But as long as the company's earnings expectation is moving forward, is intact, and the company will be okay, right? Then right now the current price is basically a bargain. That's how I see it. And then let's have a look at this. Okay, if you look at the Morningstar valuation, Seeking Alpha valuation, Simply Wall Street, and then I've used the dividend model as I used a discounted cash flow model. All of these gave me more or less similar sort of a price. This is maybe the outlier. That's $167 per share. We've kind of got average intrinsic value of $151 per share. Let's go to 152, right? Current price is 126. That's 20% discounted right now. Even if you say this is a very risky business, I want 20%, you can buy it today basically for that price. Okay, even if you say, you know what, I'm gonna I know the company is okay, nothing is gonna happen, $129 per share, I'm gonna buy until it gets to 130, and then I'm gonna stop buying and then leave it alone. Okay, you still buying a company that is still undervalued. So it is a bit of a risky. This is the time. This is basically what one of the companies where one of the situations where Warren Buffett used to say, you know what, he used to look for this type of business that are not liked right now, not loved right now. People are basically staying away from it, and he looks at the financials and says, you know what, this company is intact. We've already seen basically the financials, we've seen the income statement, we've seen the balance sheet, we've seen the cash flow. Things are a bit cyclical, but there's nothing huge to worry about. We've seen the growth expected moving forward, and we've seen what other analysts actually are saying about the company. So overall, I genuinely think this is a bargain right now, and I'm going to continue buying, inshallah. Before we move on, I'm going to show you exactly how many shares I have. I do have how many? 51 shares. Will be buying more. I'm gonna try to get to 60 shares, inshallah, in the next few weeks, inshallah. I'm down 22%. Okay, it bounced back at some point to almost I think it was $800 down, pounds down, and then it went back again. It doesn't matter what was happening. My average is 160 right now. I'm gonna start buying more until I reduce that, inshallah, and that's my long-term plan. This is the type of businesses I want to hold for a long run, for the dividend side of things, and inshallah for the dividend growth as well. This is still a dividend growth company in my opinion. Again, that's my opinion. Again, don't go away and buy the company because I said it. Do your own research, because there's a massive risk in just following someone else's analysis and so on. That's my perception of the company. Your perception might be different. My situation, your situation could be different. I've got a long time until, I don't know, I can wait for another 10 years if I need to. If you've got a short period of time that you want some income, some whatever it is, then your situation will be different to mine. So just be mindful of that. Anyway, if you can join us on the Patreon account, that would be really helpful. Have a wonderful day. Assalamu Alaikum.